Welcome everyone to this SAICA level explainer. Today we are absolutely mastering the General Deduction Formula, or the GDF. Look, if you're a CTA or BAccSc student, you already know this is the heartbeat of South African corporate tax. We are jumping straight into the two most heavily tested, incredibly complex elements of the formula, in the production of income and not of a capital nature. So grab your notes and let's get into it. Here is our quick game plan for today. We're going to do a rapid recap, dive deep into producing income, tackle capital nature, go over exactly how to handle these in an exam, and then wrap it all up with a master scenario.
All right, starting right off with a quick recap of the GDF elements.
Remember, the General Deduction Formula brings together the positive test in Section 11A and the negative test in Section 23G. Now, before you even glance at the 5 elements, there is a strict prerequisite. The taxpayer must actually be carrying on a trade. Once you're over that hurdle, there are 5 requirements. You've already crushed expenditure and losses, actually incurred, and during the year of assessment. So today we're putting all our energy into the final 2 hurdles. Element 4, in the production of income, and Element 5, not of a capital nature. And remember, every single one of these 5 must be met to get that deduction. Okay, let's roll right into Element 4, in the production of income. Before we even start looking at court cases, we have to look at the Act itself. When Section 11A says production of income, it is strictly talking about income as defined in the Act, and that means gross income less exempt income. So here is the absolutely crucial takeaway. If you incur an expense to produce exempt income, it completely fails Element 4. There's a classic exam trap where a company spends, say, our $3,000 to earn our $5,000 in local South African dividends. Well, because local dividends are exempt, they literally don't meet the definition of income, so that our $3,000 expense, it's dead in the water. Absolutely no deduction. Right, so when we talk about producing valid income, the ultimate legal precedent you need to know is the Port Elizabeth Electric Tramway case. The court handed us a golden phrase here, necessary concomitant. What does that actually mean for us? Basically, an expense doesn't necessarily have to guarantee cash flowing in, but it must be a necessary concomitant, like an unavoidable or very closely linked accompaniment to the actual activities that earn the income. To make this practical, the PE tramway case actually gives us a really strict, repeatable 2-question test. When you're sitting in the exam looking at a weird expense, ask yourself this. Question 1, what specific action caused the expense and what was its purpose? And question 2, is that action so intimately connected to the income-earning operations that it's basically just part of the cost of doing business? If you can answer yes to both, boom, you satisfied Element 4. Over the years, other court cases have added some really important nuances to this rule, so let's rapid-fire through them. First up, Sub Nigel. This case is huge because it tells us the expense just needs the purpose of producing income. It doesn't actually have to succeed in making a profit. Next, we have BP South Africa from 2006. Here, the court ruled that the actual purpose of borrowing money dictates its deductibility. So if you borrow money to fund your daily income-earning operations, the interest on that loan is in the production of income, even if you eventually use those specific borrowed funds to pay out a dividend. Then there's Jaffe & Co. Can you deduct expenses related to your own negligence? Well, only if that negligence is an inevitable concomitant of your very specific trade. We also have MTN Holdings, which tells us that if an expense has a mixed or dual purpose, like it earns both taxable and exempt income, you have to do a fair and reasonable apportionment. Finally, Provider v. COT ruled that paying voluntary bonuses to induce your employees to stick around is in the production of income. Why? Because happy, retained employees produce future income. Makes sense, right? Let's test all this theory with a practical application. Imagine ABC Lynn runs a passenger transport business. Tragically, one of their drivers dies in a fatal crash while on duty. ABC Lynn decides to voluntarily pay R$100,000 in compensation to the driver's dependents. So is this voluntary payment in the production of income? Think back to that PE tramway test we just talked about. Let's see how perfectly this model solution aligns with the case law. Question 1, what action caused the expense? Well, the employment of the driver. And what was the purpose of employing them? To earn transport income. Question 2, is it closely connected? Yes, absolutely. Employing drivers in a heavy transport business carries an inherent, unavoidable risk of traffic accidents. It is literally an inevitable concomitant of this specific trade. Therefore, that our $100,000 compensation payment is directly in the production of income. The deduction is allowed. Moving right along to Section 3, Element 5, not of a capital nature.
So the Income Tax Act conveniently forgets to actually define what capital means. This means we are once again relying heavily on case law. But as a general baseline rule of thumb, capital expenditure is usually a once-off payment made to acquire a source of profit. Revenue expenditure, on the other hand, is a recurring payment to work that source of profit. Think of it like this. You buy the machine with capital, but you fuel the machine with revenue.
The absolute foundational case here is new state areas. This is the case that gave us the famous operations versus structure test. It's simple but powerful. If the money is spent performing your daily income-earning operations, it's revenue. But if you spend the money to establish, improve, or add to the income-earning structure of the business itself, then it's capital. Always ask yourself in an exam, am I operating the business right now, or am I building the structure of the business? Now, we expand on this structure test with two major precedents. First, Rand Mines. This case confirmed that any expenditure closely related to acquiring or enhancing an income-earning structure, like buying an income-earning right, is automatically capital, unless, of course, you actively trade in those rights. And then we have that BP South Africa 2006 case again, which is fascinating. BP prepaid years and years of rent to lock down prime petrol station locations. Now, why did the court step in and say no? Because they realized this wasn't just standard operational rent. The whole purpose of the massive prepayment was to establish a long-term strategic structural advantage. Therefore, it was classified as capital, very much akin to a lease premium. But then, just a year later, we get BP Southern Africa 2007. This case is crucial because it gave us the enduring benefit test. The court basically said, look, if you aren't creating a new capital asset that provides an enduring benefit, enduring in the way that fixed capital endures, then the expense naturally leans toward being revenue in nature. So recurrent costs paid merely for the use of another person's asset falls squarely into the revenue category. Let's lock this down with another quick application. Say Tech Corp pays a once-off R1 million to completely buy out a patent. Separately, they pay R50,000 every single year in royalties to merely use someone else's software. Are these expenses of a capital nature? Let's apply the precedents. Looking at the model solution, we can clearly see the new state areas and BP tests at play. That R1 million to buy the patent outright, it is permanently adding an asset to their income-earning structure. It creates a clear, enduring benefit. Therefore, royalties paid for the acquisition of IP are capital in nature. But what about the R50,000 annual royalties? Those are just recurring operational costs for the mere usage of an asset. They don't create any new structural asset for Tech Corp whatsoever. Therefore, royalties for the mere use of IP are revenue in nature. See the difference? All right, Section 4, Exam Technique for Elements 4 and 5. Now, you absolutely must use the IRAC Master Framework. This is the secret sauce to passing your SAICA papers, because just knowing the case law is literally only half the battle. First, explicitly identify the issue. Don't just generically write, it is deductible. You need to say, the issue is whether the expense is of a capital nature. Second, state that the element isn't defined in the Act and refer to the specific case principle, like new state areas. Third, and pay attention, because this is where you earn the bulk of your marks, apply that principle to the exact facts in the scenario. Finally, conclude definitively on that single element. Let's bring this all together in Section 5 with an integrated master scenario. Here is your scenario, the kind that separates the passing scripts from the failing ones. BuildCo pays a massive $500,000 sign-on bonus just to induce a rival's top engineer to jump ship and join their team. Later that same year, they pay $200,000 in legal fees to defend their factory's land title in court against a challenger. Discuss the deductibility of both of these expenses under Elements 4 and 5. Let's break down exactly where the marks go. For the R500K inducement, you need to cite provider VCOT. State the principle, inducing an employee to enter service has the direct purpose of producing future income. Because it's an operational employee cost, it is revenue, not capital. Boom, 3 marks. Now, for the R200K legal fees, you have to recognize the true nature of the expense. Legal fees always take their nature from whatever it is they are defending. Defending a land title is protecting a core asset, your underlying income-earning structure. Therefore, it is of a capital nature, which means it fails Element 5, not deductible. Another 3 marks. And that brilliantly illustrates the absolute tightrope walk of the General Deduction Formula. You have to constantly weigh daily operations against underlying structure. So as you head into your next past paper, I want you to keep this thought top of mind. What is the hidden risk in the scenario? Because if you don't secure the capital structure, do you even have an operational trade left to produce income in the first place? Keep questioning the true core purpose of every single expense. Thank you so much for joining this explainer, and best of luck with your studies.